Global Cord Blood Corporation, stock ticker CO. Can this Chinese stock 10x your investment? That's precisely the question we asked ourselves within the Chinese Alpha Equity Research team. And I'm super proud that today with my colleague Kevin, we can present the results of our research to you. Now, all the information written, spoken, or discussed in this presentation is purely for educational and entertainment purposes only. None of it is intended to be financial advice. Please talk to your investment advisor before you make any investment decisions. With that out of the way, let's get right into it. Why the hell should you even care? Now, in our blue sky case, you have the potential to 10x your investment within a realistic time frame by investing into CO. We're looking at monopolistic market structures, and you are investing in the monopoly, which is of course something we like to do. High compatibility with both professional investors as well as YOLO investors that don't care about fundamentals at all. And what's nicer than getting to call yourself a life science investor on LinkedIn, further boosting your CV. Let's get right into it. Here's the agenda. Today we're going to talk about the company overview. I want to give you the ethical implications of cord blood, give you a qualitative analysis. After that, my colleague Kevin is going to take over with the quantitative analysis, the risks, as well as the investment conclusion. Let's talk about the company, all right? Global Cord Blood Corporation, stock ticker CO, is a microcap biotech company headquartered in Beijing. Now you're probably asking yourself, what on earth is cord blood technology? I ask myself this question too. There are some people on the team like Kevin who are extremely knowledgeable, but we are going to give you a very short excursus here on cord blood. Now, cord blood banking is basically when you as a parent are extremely concerned about your child getting some diseases in the future, and you want to extract those stem cells out of the child's cord blood during birth. Okay, so child is born, cord blood is taken, stem cells are being extracted. What's that for? These stem cells can be potentially life-saving further down the road if the child gets a couple of very serious diseases, and these stem cells are good insurance against that. Of course, they need to be stored in liquid nitrogen tanks, so storage is expensive, right? And there's a lot of private companies entering this space, like for example CO. Now, let's get back to CO. They are cooperating with more than 360 hospitals currently. They are expanding across the APAC region, and they get our feminist stamp of approval because 3 out of 4 management executives are female. Lastly, if it bleeds, it leads. Not sure what sense that statement makes in this context, but it's nice to say that if it bleeds, it leads, my friend. Ethical implications of cord blood technology. LOL, nobody cares. Let's focus on profits, all right? Who cares about ethical implications? All right. Qualitative analysis. Let's get into that. So CO is serving private and public industry segments with their private services and public services. And that of course is great because it's great for revenue diversification, first of all, but secondly, it's also great for ethics, which you know we care about a lot. What does the business model of CO look like? Now, in the private services, what happens is you pay a processing fee. So child is born, you pay a processing fee. Now the stem cells need to be stored somewhere in the storage facilities of CO. So you pay a storage fee every year. These stem cells are being stored. For private services, there's also a second option. You can choose an upfront payment plan. So you're paying the processing fee. At the same time, you're paying a one-time payment storage fee. Okay, so that means cash is collected upfront in year 1 immediately. That of course creates significant deferred revenue and gives us the potential to invest in the future. On the public services side, this makes up just 1% of the total revenues of CO, but it's projected to rise. They get 15,000 RMB per client matching fee. Now, the market is heavily growing, both public banks and private banks. That's a good sign from 2014 to 2025. Great growth is being projected in the future, and we have much more potential to expand. So CO currently is licensed to operate in 7 regions in China. Okay, they are operating in 4. So that means they can, without any problems, expand to 3 more regions, right? It's almost doubling their amount of regions that they're active in. And now the regulatory body, NHC, government regulations, what they are thinking about is further increasing the limit of regions that players like CO can be active in. So they would increase that to 19, giving CO a potential additional 12 regions that they can conquer in China. That's amazing news, and that could mean massive, massive growth. I hope you realize that. So in total, 15.2 million newborns in 2019 across 30 regions. That's of course also pretty impressive. Now, we know that in 2016, the one-child policy was abolished in China. In 2021, so very recently, the two-child policy was abolished. So the three-child policy is taking place. And what does that mean? It probably means increased reproduction activity is possible and might happen in the future. That's of course also great news for a service like CO. GDP is growing. We know that. Even though it's growing a bit slower in recent years, China's GDP growth is still massive and very impressive. At the same time, also healthcare expenditures grew massively. That's good news, okay? It grew tenfold from 2000 to 2018. That's impressive and super important for us. At the same time, public awareness towards healthcare and that hot water, for example, is not the solution to everything, is growing. Great news. Lastly, GCBC faces almost no competition. As Peter Thiel pointed out correctly, competition is for losers. On this picture, he's indicating certain attributes of people who invest in companies with competition. So you don't want to be liable of investing in these kind of companies. And that's what CO is not. They have almost a monopoly. But we want to point out that there's a possibility that the NHC, so the government regulators, will take the position of a fee-based banking service. And that, of course, would drive down prices of CO storage service a little bit. But this is highly speculative. We want to point it out. Nevertheless, there is this small possibility that this could happen. Now, let's go on to the quantitative section with my colleague Kevin.
Hello everyone, my name is Kevin Francis Marqueda. I'm one of the equity research analysts here at Chinese Alpha, and welcome to the quantitative section where I will break down the income statement, the cash flow statement and the balance sheet so you don't have to. And by the way, I am a biomedical scientist, so this is particularly one of my specialties, especially in analyzing in biotechnology companies such as Global Blood Corporation. So just a quick overview of the income statement. Just to summarize it, it has very huge growth potential. This is primarily shown in its revenues over the last 3 years, which has been consistently rising between 2018 to 2020. However, at the same time, we actually see a rise in cost of goods sold, meaning that the cost of the materials, the cost of the labor has also risen at the same time. However, it hasn't risen to the same percentages as revenue, meaning that the gross profit, the amount of money it makes at the end, is becoming more efficient as the company is becoming more efficient over time. And what is quite interesting here is that despite the revenues increasing, the number of quarterly new subscriber signups have actually decreased over the 2021 period. And as many of you know, this is due to the pandemic. So the revenues are actually, these subscribers are actually driven by the number of newborns that there are. And because there was a decrease in the number of newborns, primarily because there's a higher risk of contracting illness at hospitals, this decreased the number of newborns potentially over that period, which decreased the number of subscribers that there were. And on top of that, they weren't in hospitals, and therefore they could not market their product as effectively. However, because despite this, their revenues increased, and this highlights very strong pricing power from the company. And also, in terms of revenues in the future, because this company only operates in 3 out of the 7 counties in which it is licensed for, there's a potential for the company to expand its operations in other regions of China and potentially increasing revenues over a longer period of time. And what is quite interesting also is that it has very high turnover ratios. In fact, its turnover ratios have risen year on year and year. So things like ROE, ROI, and ROA have all risen. And on top of that, it has very high margins. In fact, its net income margins hover between 30 to 40%. And this just goes to show how operationally efficient this company is. So just quickly looking into the balance sheet, the balance sheet actually indicates a very strong financial position, and in fact, this company has a negative enterprise value. So when you're buying the stock, you're effectively buying it for free because of the amount of cash and equivalents that it holds. In fact, this cash is so high that it can pretty much pay for all of the liabilities. And this is why the current ratio is at 9.9x, which, to be honest with you, I've never seen current ratios this high before. And because they hold so much cash, this enables them to be able to buy out smaller businesses, buy out other businesses, smaller players in the region, enabling the company to grow bigger. And on top of this, because it holds a lot of cash, it has a lot of high liquidity, meaning that they can sell off their assets very quickly, they can buy things very quickly. And this is particularly good during the middle of a pandemic where cash is king, and again, very important. And a testament to this cash and equivalents is this unearned revenues here in the liability section. And because it has quite high unearned revenues, in fact, it constitutes pretty much a good portion of the amount of current liabilities that there are. This suggests to us that the company actually collects the cash up front. So before actually giving out the service, they collect the cash through maybe signing these clients up really early on, as soon as they are in the hospital themselves. And again, another interesting thing which contributes to enterprise value is the low debt. So the company has absolutely no debt, and even if you include leases as debt, its debt only amounts to around 0.6 million US dollars, which comparatively, compared to the amount of assets it holds, that is a very, very tiny amount. So we'll just quickly analyze the cash flow statement real quick. So the cash flow statement is quite interesting because it suggests to us that this company has, in the short term, it has quite lower liquidity, and that's primarily due to a decrease in cash from operations due to a drop in the unearned revenues. And this is quite logical because customers are less likely to pay upfront. Therefore, during the middle of the pandemic, especially when cash is king, so we actually saw a decrease in cash from operations as a result of this change in unearned revenues. And also in 2020, we see a large cash outflow in cash from investing. And in the short term, this is quite bad because this results in lower cash flow for the company. However, over the long term, because this is for a long-term investment, this is very good for long-term investors. This actually resulted for the business acquiring shares of Cord Life Singapore, which is a multinational cord blood banking service provider in Asia, meaning that they're planning to expand their services not just inside China, but also within the Asia region, which is good for long-term investors. So the difference between amateur investors and professional investors is forecasting the financial statements forward. And one of the most important things to forecast is the revenues. So in our Chinese Alpha team, we actually do these forecasts quite regularly. And if you want to see more of our forecast in a lot more detail, please check out our website, ChineseAlpha.com. So from 2020 and 2027, we expect a CAGR of 9.4%. And between 2028 to 2032, we actually expect this to drop to around 4% because we want to ensure that our valuations are actually conservative. And using the discounted cash flow analysis, we find that the company is highly undervalued. In fact, the intrinsic value is around $38 for our base case scenario. And considering that it's trading between $5 to $6 right now, this goes to show that this company is pretty cheap as it is right now. And even if we look at our sensitivity analysis, so the higher discount rate here, the more conservative the valuation, even with highly conservative valuations, we still see around $25, which is still a 5x upside for the current price right now, trading at in around $5. And for our scenario forecasting, so we forecast different scenarios for the company in case that our forecasts are worse than expected or better than expected. And again, we do this primarily so we know all the potential outcomes that there are. So it's a bit like holding the time stone. We see in the future of the different scenarios and how we can plan for them. And in our grey sky case, we expect in and around $40 for the stock. And again, you can see our assumptions. So it implies a 6% CAGR until 2027 and a CAGR of 3% to 2032. Again, this is a more conservative valuation for $40, but still relatively high compared to where it's trading at right now. And in the blue sky case, we imply a higher growth until 2027 and a higher growth until 2030. And we also expect the partnership for God Life to be successful for our blue sky case scenario, which is around $50. So with our technical analysis, this is quite interesting. As you can see here, Pointy Nipples, funny joke. Again, we see very strong upwards momentum for the company, especially over the short period of time. And this is actually broken through its previous resistance without much resistance being shown. And right now we see a falling wedge pattern, which is actually indicative of a bullish shift of momentum to the upside. Also, the price is trading at a very strong dynamic support, which has failed to break through previously. And this suggests that the momentum for the downside is actually beginning to decrease. And in order for a buy scenario to occur, we want this stock price to actually break the weak resistance. And if it breaks, this is our indicator for entering this trade. So for our risks, very important again to understand the potential problems with this company going forward, especially as a retail investor. So the first risk we identified is that it might not be able to attract enough clients because its business is fundamental to its penetration rates, and that's dependent upon it spreading its awareness of the benefit of stem cells. So if, for instance, stem cells fail to actually meet the expectation of the public, this may result in less clients actually wanting to invest or be part of the Cord Life system, and this could be particularly bad for the company. And on top of that, another driver to this cannot attract clients is that China actually has a decreasing birth rate with fewer newborns each year. However, because of recent policies in this year, actually, China announced that they would have a 3-child policy, increasing from a 2-child policy recently. This can mitigate some of this concern. Again, potentially increasing the number of newborns over a long period of time. Also, because this company holds a lot of cash and marketable securities, there's actually a risk of inflation, simply because if inflation rises, the cash and the marketable securities have lower purchasing value, and therefore the valuation for this company would decrease. And also lastly, the company, because it's effectively a monopoly, it only competes against smaller players. It may be targeted by antitrust regulations. However, historically, we've only seen regulations targeting large cap companies such as Tencent and Alibaba. However, it's still a potential risk, which is mitigated by how small the company is in terms of market cap right now. So in terms of our recommendation, we recommend a strong buy, simply because the company has short-term trading potential. And on top of that, there are economic and social trends which can actually boost revenues, and there are also fundamental drivers such as it potentially moving its operations, expanding its operations to other regions that it is licensed for. So currently, right now, 3 is in which it operates, but it could potentially operate up to 7. And also, based on our valuation, we see this as being highly undervalued. In fact, it's around a 7x undervalued scenario for our base case, and about a 10x for our sky blue scenario. So I thank you very much for staying with us throughout this presentation. We really do appreciate it. And if you want to learn more about this stock or other analyses, please check out our website, ChineseAlpha.com. And if you want to be part of a China investing community, we also have a Telegram, which is linked below. And please give us a like, subscribe, and ring that bell notification. It is very important, especially if you want to see more analysis from me and Kevin Warner. So on behalf of Chinese Alpha, thank you very much, and I hope to see you in the next video.